Okay, it's time for Hot Picks, where we speak to an investing professional about their highest conviction stocks in a sector. Today, we're looking at American retail. Let's bring in Seth Basham, Managing Director of Equity Research at Wedbush. Seth, it's a great day to have you, particularly on a day, and I know it's not a sector you cover, but we're getting some concerns about the high-end luxury market from Capri, which owns, Michael Kors, Jimmy Choo. What does that say about the overall health of retail right now?
Sure. Overall, retail is in a tough spot right now. No doubt that it had a tough end to 2022 and a tough beginning to 2023. That said, I think there are select areas of retail, especially less discretionary areas, that are pretty attractive. And there are also some more discretionary areas that have been beat up pretty badly that could have some stock break opportunities.
And we're going to talk about those. But Seth, you made headlines yesterday because one of those areas, obviously, is not Bed Bath & Beyond. And you put just a $0 price target on this one. Do you still have to watch it in terms of the wild ways that investors, if you can call them that, push into the stock?
No doubt. This is the Wild West of trading. It's a meme stock, Bed Bath & Beyond, and it could be very volatile from here. So the company was able to raise capital yesterday, and that gives them a lifeline. There's a chance of survival here, but it'll take a small miracle for them to turn the business around. So we see the prospects of bankruptcy is still pretty high, but they'll be delayed.
Okay, so let's marry your outlook with some stocks here. Tempur Sealy International mattresses. That sounds like a nice, boring, stable business to invest in.
Well, you'd be surprised. The mattress industry has been pretty volatile. And if you think about the need to buy a mattress, it's one that doesn't happen every year. And it's also one that you can defer pretty easily. So we saw really tough sales for the industry in 2022. 2023 is starting off a little bit better, but we're still looking for slightly negative used, or should I say, unit sales, and flattish industry dollar sales in 2023. That being said, we think that Tempur is really well positioned to capture additional market share. One of its largest competitors recently filed for bankruptcy protection, Serta Simmons brand. And we also see the company being able to benefit from much lower commodity costs and potentially pursue an acquisition of its largest retail customer, mattress firm. That would be highly synergistic.
Here's a question. When we have a mattress company here, Sleep Country, and I know that it tends to ebb and flow depending on what's going on with the housing market. If you buy a new home, you're typically buying a new mattress, a few of them at least. With what's gone on in the U.S. housing market, could this also be a play on a recovery there?
Certainly, and some investors are looking at it that way. About 70% or so of mattress sales are driven by replacement demand. The other 30% is more discretionary related, and that discretionary component is highly driven by what's happening with existing home sales. And if we see those start to come back as we move through 2023, that would be a plus for Tempur. And we are looking for sales to materially improve through the year.
Let's talk about another one that you like, an online retailer for pet food, which we know, went crazy during the pandemic. How are they managing post-pandemic life as Chewy?
Yeah, so Chewy, its business surged in the pandemic, as you mentioned. They acquired a ton of new customers, and in the subsequent year, really 2022, we saw the business soften. They had more difficulty holding on to their customers and some difficulty acquiring additional new customers. We're seeing more stable trends through 2023. We think customers should start growing again. And we should see less pressure on the discretionary hard goods side of their business. The core consumables or pet food side is very steady, and that provides good visibility to revenue growth in 2023 as well. When you couple those factors along with an improving margin outlook as the company's getting more efficient with its operations, there's good reason to believe the company will be able to increase its EBITDA materially in 2023, and that should drive stock price outperformance.
Let's round it out with your final pick, which is Dick's Sporting Goods, and this is pretty close to its peak in 2021. What do you see as a further catalyst for upside?
Yeah, the stock is still trading below its historical valuation multiple. So that provides some support and room for upside. But the key for the stock in terms of its fundamentals is the fact that the sporting goods industry has re-baselined in sales coming out of the pandemic. There are certainly some pockets that had pulled forward demand, such as home fitness, for example, and the outdoor category. The company doesn't have much exposure to outdoor and home fitness. The pressure has mostly moved behind us. So in 2023, there'll be some discretionary demand pressure, but there'll also be continued strength in areas such as apparel and footwear. And that's positive for the company. At the same time, they've done a great job in improving their margin structure, and the street's not giving them credit for that. We think that their merchandise margins and their overall margins, for that matter, should be flat to up in 2023, and that should drive outperformance relative to more dire expectations.
Pretty big short position, almost 17% of shares outstanding are short. What are the concerns there, and is this a company that is struggling with inflation?
Yeah, the biggest concerns there are related to the margins. As I mentioned, people are expecting their margins to fall backwards, especially as the promotional environment potentially intensifies. We saw more promotions in the third and fourth quarter of 2022, and we may not be back to the full normalcy of promotions, but we're not expecting hundreds of basis points of margin pressure in 2023 the way some are. So as it relates to inflation, yes, inflation is an issue for the company, but they've been grappling with it. The biggest area of inflation for them is in their cost base and their labor base, but they're making sure that they're paying competitive wages and providing great service. That's a key differentiator to their model.